Welcome back to another video, and if you've seen the thumbnail, yes, I sold out of USCL. As part of going through my holdings for the end of 2025, this was another one of those larger positions within my portfolio that I try to keep a closer eye on in terms of performance. This was one of my longest held holdings in the portfolio, having held it for almost 2 years since its inception. It's done quite well in the time that I've owned it, but I started noticing a growing difference in performance, where I decided to finally make a change and sell it off. So in this video, I'll go over what I saw and what led me to the decision to exit my entire position of USCL. If you haven't subscribed yet, as a smaller channel, it would go a long way in showing support and growing it with a larger audience. So if you enjoy this analysis and want to follow for more, consider subscribing for future videos. Now let's get into the analysis. So just for some context to those who may not have known or were aware, USCL was actually first launched in July of 2023 under Horizons ETFs. Then on March 6, 2024, they announced that they would be undergoing a rebrand from Horizons ETFs to now become Global X Canada. Personally, I started buying into USCL on December 18th, 2023, and I've treated it as a core S&P 500 index position in the portfolio. By the time I sold it on November 26, 2025, it was just about 1 month short of the 2-year mark. In terms of size within the portfolio, at the time of selling, it was basically tied with QQCL for the largest position at an 8.07% allocation. For unrealized gains, it was up $1,384.30. Annually, it brought in $1,284.78 in terms of distributions. And then, during the time I've held it, I've collected $2,232.74 in lifetime distributions. Overall, the total return for USCL was approximately 31.22% after 2 years across 2 accounts. This would have actually been higher, but because over time I added more to the position, which is why the total return value is lower when you compare it directly to the index returns. So this isn't the reason why I decided to sell, because that's just how the total return calculation works when you invest more over time. To showcase this, we can use the Canada Stock Channel to also compare the returns and verify. So by putting in the start date of my initial purchase, and then the end date of when I exited the position, we can then also put in VFV as the comparison index, because both of these are unhedged. And as we can see, without dividends reinvested, USCL trails VFV in total return by about 5.55%. With dividends reinvested, it actually comes out ahead, and edges VFV by about 0.12%. So the performance here has been fairly close between the two of them from this comparison. What then would be the reason for selling out of USCL then? To answer that, we'll have to head over to the Canadian Covered Call ETF dashboards that I built in order to see the comparison to other similar S&P 500 ETFs. So let's head over there now. So as a Patreon member, you'll be given access to a range of sector-specific dashboards on Google Drive. Because USCL is based on the S&P 500 index, we'll scroll down to open the S&P 500 spreadsheet. Here on the spreadsheet, you'll first see the chart for the total return comparisons year-to-date performance. And for reference, the screen recording for this was done on December 30th, 2025. What this chart shows you is the total return of all the similar ETFs at a single glance. And the one that clearly stands out in performance over all the others would have to be none other than HYLD. Seeing this, it's not even close, with the next highest ETF being the index itself in VSP at 16.60%. Of course, it needs to be mentioned that HYLD isn't exactly the S&P 500 itself, and is intended to only be broadly similar in terms of sector mix. But that still shouldn't take away from the performance it's had over the course of 2025 when compared to all the others. To find USCL in this mix, it's here at the end at a 9.59% total return. While it's not terrible, USCL along with USCC are underperforming all the other ETFs on this chart. A part of it has to do with the currency hedging, but even accounting for that, it has underperformed by a fair margin. To get a sense of what the currency hedging impact is, we can compare the difference between VFV and VSP. I've included these 2 bars here specifically for this purpose, because VFV and VSP are both the S&P 500 index, but the difference between them is the currency hedging. So subtracting the values, we get an approximate 3.80% difference. This isn't going to be the exact impact of currency hedging, but it gives us a rough idea to see in practice. Now, using this value, by adding it on top of the 9.59% of USCL, we get 13.39%. So even accounting for the currency hedging, we're still 8.18% away from the total return of HYLD. Both of these use 25% leverage, so that isn't the cause for the difference. The only other reasons I could point to would then have to be the portfolio coverage, covered call writing performance, fees, and underlying holdings. When it comes to covered call writing performance, we don't have access to the actual trades they do on a weekly or monthly basis. But what we can look at is the coverage, and generally how much of the portfolio do they cover to generate the monthly income. Generally, with more coverage, this means that you're potentially giving up more of the upside of the underlying holdings. With less coverage, it means that you can then capture more of the upside price appreciation. So, looking at USCL, they actually show this on their product page. If we scroll down, we get to the section labeled Portfolio Investment Metrics. Here, it shows the average coverage, average moneyness, average option annualized yield, dividend yield, and indicative yield. If you want more information as to what each of these mean, you can hover over the question marks. But what we're interested in here is the average coverage and average moneyness. So it looks like they are generally at around 50% coverage, and basically at the money for their options. This means when the index goes up in a rally, we can expect to only have about 50% of the portfolio participating in the upside. The other 50% will then be used for covered calls, and generating that monthly income being distributed. If we look now at HYLD to compare, we can scroll down to the holdings. It doesn't list the coverage for HYLD, because all it does is hold other Hamilton ETFs, but what we can do is look at what the largest holding is doing. And we can see here that SMAX is the largest holding within HYLD, making up almost 60% of the allocation. Many on this list are actually from the same product lineup from Hamilton, which is their Yield Maximizer ETFs. There are also two Daymax ones, but those are only added recently and are smaller in comparison. So focusing only on the Yield Maximizer ETFs, we can go to the product page of SMAX to find out what the actual coverage ratios are. Here, on the page, while we can't actually see the up-to-date values, we can see that it is an actively managed coverage ratio of approximately 30%. So compared to USCL's 50% coverage, the Yield Maximizer ETFs will be able to capture more of the upside. In addition to this, we also have to keep in mind what I mentioned earlier on in the video, and that HYLD is intended to only be broadly similar to the S&P 500. What this means is if we scroll down further, is that they hold a more concentrated selection of stocks, and then rate covered calls on top of them. And this has its own benefits, as Nick Picard has mentioned in an interview with Adriano from Passive Income Investing.
The first thing is, our underlying portfolios, where for each of the funds, that's a fairly, passive process. We own the largest companies in the sector with a good options market. So we try not to be stock pickers. We really just want to own the best companies, and generally the best and largest companies are the ones we're going to have the largest market cap. They're also going to have the best options market generally. So that makes it a nice attribute to those stocks.
And then when it comes to how the two option strategies compare when you rate on individual stocks versus the indexes, he had the following to say.
Now, in terms of writing on the individual stocks versus the underlying indices, because we don't actually own all of the indices themselves, it's difficult. It can be risky to write on the index, just because if the index goes down or up, and your underlying stocks are going to be highly correlated, but they're not going to be 100% correlated, and so you're going to have some risk between what the index does and what your underlying portfolio might do. So we just focus on the underlying stocks. In addition, by focusing on each of the underlying stocks, we can get more premium than if we just wrote on the index. Generally, index volatility is going to be lower than the individual volatilities of the stocks. And so you can earn more premium by focusing on the individual stocks, because if you think about even just large tech stocks like QMax, you're going to have Nvidia, you're going to have AMD. These are large semiconductor stocks with quite a bit of volatility on which you're getting quite a bit of premium. But if you're looking at the index, all of these stocks kind of offset each other, and so index volatility might be quite a bit lower. So you're not going to get the same amount of premium. So we just focus on the individual names. That's plenty of premium for us to take. And generally it also means that we don't have to write as much. If we had to use the index options, we'd likely have to write more and have a higher coverage.
So that last part aligns with the point being made, where USCL has to cover closer to 50% of the portfolio in order to deliver the yield. Whereas for the yield maximizer ETFs, they can get away with only covering around 30% of the portfolio. And generally, the highest market cap stocks are the highest for a reason, and that's for their growth potential. So, because they cover less of the portfolio, and also have the best performing individual stocks within each sector, they're able to capture more of the upside for HYLD. And in the case of USCL, the lower premiums on the indexes, in addition to having to cover more of the portfolio, means it also captures less of the upside by increasing the chances of being capped. I think it's good to be reminded again that while USCL generally does provide a slightly higher yield than HYLD, you can't ignore the total returns. By choosing to not care about the total returns, it means that you're leaving money on the table that vanishes into thin air. As seen here in the chart, you've missed out on 11.98% of returns, which could have been sitting in your account as unrealized gains. Yes, you can't use it unless you sell, but at the very least you have the option to do so in the future if you need it, rather than not having it at all. So, given all these reasons and details, is why I've decided to sell out of USCL completely and reallocated it all to HYLD. Throughout my time, I've kept both these allocations mostly equal, because I saw it as covering both the hedged and unhedged exposure to the S&P 500. So this means I still captured the upside with my HYLD portion, but missed out on some gains with my USCL half of the portfolio. It was a difficult decision to make, because USCL is strictly following the S&P 500 index directly, but the outperformance here was just too significant to ignore. The risk here with this switch to HYLD is that your exposure is on a more concentrated basket that is designed to instead broadly mimic the S&P 500. So you would have a more concentrated exposure to the best performing stocks in each sector, and in turn will likely miss out on the other remaining stocks in the index. There's also no guarantee that this past performance will continue, so that's also something else to keep in mind. With the sale of USCL, I actualized a profit of $1,397.41, with a total of $2,126.63 in distributions collected, for a total return of $3,524.04. In terms of percentage, that would be a total return of about 38.86% on a non-ACB adjusted basis after owning it for almost 2 years. If we divide this by the 2 years, that would be approximately 19.43% return per year. And as mentioned, I ended up putting most of this into HYLD to double up on my allocation within the portfolio to maintain the S&P 500 exposure. And actually, during the making of this video, I've now also sold HYLD in this portfolio, as I've adjusted my plan going forward for 2026. So if you want to find out what I've done and what I plan to do for this year, make sure to subscribe so you're notified for the next portfolio review video. If you're interested in accessing these spreadsheets for yourself, you can head over to my Patreon to become a member. Thanks for watching, and I'll see you in the next video.